Welcome to the weekly Money Week roundup. ChatGPT is taking the world by storm, forcing policymakers to consider how to regulate the rapidly expanding artificial intelligence sector. AI has the potential to revolutionise the way we work and play, but there may be some unintended consequences along the way. For example, ChatGPT recently declared an American radio host had been convicted of embezzlement, when in fact he hadn't. The claim has landed the company behind it, OpenAI, in hot water. It's now being sued for libel. This is just one of several events that sparked a debate about AI and who's responsible for the technology. Should software companies be responsible for a technology with the ability to learn for itself? The answer to this question isn't simple, but if a company can't make its product safe, it shouldn't be allowed to sell it. That's true of pharmaceuticals, food, and cars. That's why the case against OpenAI and ChatGPT is so notable. The first of its kind legal case will set a precedent for the industry, and it could have a big impact on the future of AI. Soaring food prices have been in the news a lot recently, and it doesn't look as if that's going to change anytime soon. Last year, food prices spiked when Russia invaded Ukraine, as the country is responsible for producing a large percentage of the world's corn and wheat. But there are now problems brewing in other parts of the world. According to the US Department of Agriculture, the number of beef cows in the US has declined to its lowest level since 1962. Meanwhile, in America's wheat basket, farmers are expected to see their lowest crop yields in more than 60 years this year, as the worst drought in the US Midwest for 3 decades wreaks havoc. None of this bodes well for global food production and could signal even higher food prices ahead as supply struggles to meet rising demand. High inflation, economic uncertainty, and a war in Europe are just 3 of the headwinds making life hard for investors today. But there's one asset that stands to benefit from all this uncertainty: gold. The gold price hit an all-time high in April as investors rushed to buy the safe haven asset. However, if you want to buy the yellow metal yourself, it might be best to buy exchange-traded commodities rather than the physical product, which can be as much as 8% more expensive. The biggest gold fund is iShares Physical Gold, and the most established is Gold Bullion Securities, set up in 2004. Gold miners are usually the riskiest way to invest in the gold market, but that could change if the price rises above $2,000 an ounce. You can buy a basket of these stocks with the VanEck Gold Miners ETF.